Hi everyone, welcome back to my channel. Today we're going to talk about breaking down the most tested tax topics. This will be useful if you're studying Core 1 or if you're going to be studying for your CFE final exam for your Day 2 depth topic in tax or just Day 3 and the general tax topics as well. If you like what you see, please remember to subscribe and also give this video a thumbs up. If you have any questions, please let me know in the comments below.
And here is our game plan for doing just that. We'll start with a foundational personal tax formula, then we'll dive deep into employment income. After that, we'll tackle property and investments, and we'll wrap up with a super important distinction you'll definitely need to know. First up, the big picture. You can think of this formula as your GPS for any personal tax calculation. Seriously, every single problem is going to start right here, so getting this flow down is absolutely essential. It's really just a logical 6-step process. First, we pull together all the income from every source. Step 2, we subtract some general deductions to get our net income. And that number is key because a lot of credits and benefits are based on it. Then, step 3, we subtract another set of deductions, the Division C ones, to get our taxable income. From that number, we figure out the basic federal tax, then we chip away at it with tax credits, and voila, we land on our final tax bill, or hopefully a nice refund. It works the same way every time. All right, let's move on to our first deep dive. Employment income. This is a massive area, and trust me, it's about way more than just what's on your paycheck. We're talking benefits, allowances, all the good stuff. Now this is so important. Getting the top marks isn't just about crunching the numbers correctly. The examiners, they want to see how you think. Why is something taxable? What's your logic? Explaining your reasoning is where you really start to stand out. A classic example is the good old automobile benefit. It's always, and I mean always, broken into 2 parts. You've got the standby charge, which is for having the car available to you, and the calculation is a little different depending on if the company owns or leases it. Then you have the operating benefit, which is for the personal driving you actually do. Just remember, 2 parts, 2 separate calculations. So what about gifts from your employer? Well, instead of trying to memorize a giant list of what's in and what's out, just focus on this simple 3-point checklist. If a non-cash gift is for a special occasion, it's not a performance bonus, and it's under a certain dollar limit, it's usually tax-free. Master the logic, not the list. Stock options are another huge topic, and there's a major split you have to know. For a public company, you pay tax on the benefit when you exercise the options. But for a CCPC, a Canadian-controlled private corporation, you get to wait and pay the tax when you actually sell the shares. That's a big timing difference. The rules for the 50% stock option deduction are also a bit nicer for CCPCs. Knowing that difference is crucial. Okay, building on that, let's shift gears into our third section, income from property and investments. This covers everything from dividends you might get to what happens when you sell off an asset. Now, you've probably heard that not all dividends are created equal. And it's true. Eligible dividends, usually from big public companies, get a bigger gross-up and a better tax credit. Non-eligible dividends from smaller private companies get less favorable treatment. Just remember, it's a 2-step dance. You gross up the dividend to add it to your income, and then you use the credit to bring your final tax bill down. Okay, what happens when you sell personal stuff, like your furniture or a boat? That's called personal use property, or PUP. And there are 2 golden rules here. First, if you sell it for less than you paid, too bad, you can't claim that loss. Second, there's a weird $1,000 floor rule for both the cost and the sale price when you're calculating a gain. But wait, there's a special little subcategory called listed personal property, or LPP. This is for things like art, jewelry, or rare books. And here's the twist. For LPP, you can claim capital losses. But, and this is a big but, you can only use those losses to offset capital gains from other LPPs. So a loss on a painting can cancel out a gain on a rare stamp, but it can't touch a gain you made on your stocks. For most of us, our biggest asset is our home, and that's where the amazing principal residence exemption comes in. There's this formula to make the gain on your home tax-free, and the secret sauce is that little +1. What's that about? It's fantastic. It lets you own 2 houses in the same year, like when you're moving, and still get the full exemption for both. It's a lifesaver. So, what if you have a house and a cottage? How do you choose which one to shelter from tax? Well, the strategy is pretty straightforward. You have to run the numbers. The best move is always to use the exemption on the property that has the highest average gain per year you've owned it. That's how you maximize your tax savings. And for our last section, we're going to tackle a fundamental judgment call that comes up all the time, deciding if a sale results in business income, which is fully taxable, or a capital gain, where only half is taxed. To make that call, you've got a framework. You need to look at the person's intention, how long they held the property, how often they do these kinds of deals, and their background knowledge. But the most important point here is not just to list these factors, but to actually apply them to the facts of the case and argue for your conclusion. And why does that distinction matter so much? It all comes down to this one simple, powerful number, 50%. That's it. Only half of a capital gain is taxable. Getting a transaction treated as a capital gain instead of business income literally cuts the tax bill in half. It's a massive deal. So there you have it, a quick run-through of some absolutely critical personal tax topics. You've got the roadmap, you've got the key rules. Now the only question is, where are you going to focus first to turn all this knowledge into exam success? Best of luck on your journey. You've got this.
Thanks again for watching. If you like this video, please remember to subscribe and give this video a thumbs up. If you feel that this video can help someone, please feel free to share it with them. If you have any questions or comments, please let me know in the comments below. Love to hear if you feel that any of these tips or tricks work, and if you're struggling with any tax concepts. Thanks.